Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and issues that we have been discussing here at Quilter Cheviot. I'm Oli Creasey, Head of Property Research based here in London, and I'm joined as always by regular commentator and Head of Fixed Interest Research, Richard Carter, as well as our Head of Tech Research, Ben Barringer. Welcome to both of you. Richard, we'll start with you as usual. I wrote a load of notes on Friday, as we normally do, and did a bit of work in preparation for this. And I feel like not sure I'm going to throw it all out the window, but clearly events have moved on a little bit since then. I originally suggested to you that doing this podcast must feel like Groundhog Day for you. We're going to obviously start with a question about the Strait of Hormuz. The will they, won't they story feels like it's getting ever closer to a conclusion, perhaps even a proper end to hostilities, which I think will be excellent news economically and, of course, for the people actually living in the Middle East as well. So what do you think of the news that we've had over the weekend? Is this a false start? Is this a real deal? And I suppose I'll roll into that. What do you think of the US inflation print last week? And did that have anything to do with focusing people's minds on this outcome at all?
I think it certainly focuses Trump's mind, with the midterms not a million miles off, to try and get this deal done. And you saw how angry he was with what happened over the weekend with the kind of Israel-Hezbollah exchange and, worrying that might scupper the peace deal. So I guess the pressure is on Trump to get something done. I do worry, though, this is just going to be another false start and a sort of, chapter 5 of a book where there's going to be 20 chapters to go, because, we've still got a few days before the actual signing takes place. And when you get sort of different interpretations of what the deal means from different sides, you do start to worry. There's still huge suspicion and bad feeling between not just obviously Iran and the US, but between Iran and Israel. And you do worry that, further events and further firing going on in Lebanon might scupper the whole thing, and Iran might use any kind of excuse to then go and say the deal's off and we're going to close the Straits of Hormuz again. So I do, this is a step in the right direction. Let's see if it holds. Like you say, it really would be good news economically if it does. But I still think it's some way off before we see, sort of life go back to what it was before the war started.
I was feeling very optimistic this morning, Richard. That's a bit of dose of reality there, but a useful one nonetheless, I suppose. I'm going to bring it a little bit closer to home with the next couple of questions, really. UK GDP data, month-on-month fall in May, or actually, I guess it was announced for April, technically, wasn't it? It was minus 0.1%, so maybe not hugely significant. But I suppose the question really is that enough for the spectre of a recession to come back looming over the country once again, or is that am I over-egging that pudding?
Well, given my last answer was a bit more pessimistic, I'll be more optimistic with this one. No, I don't think it's too bad. Yeah, it was April numbers. I mean, actually, the economy got off to a pretty good start to the year, so it was always going to give a little bit back. And it's only, it's not really surprising that, given what's been going on in the Middle East, you might get a bit of a hit to the service sector and to consumer spending. So I don't think necessarily, we should start worrying about recession or anything like that. Some of the PMI data you've had in the UK is not too bad, and then if we see at least the oil price stabilise or come down a bit, then the kind of need for Bank of England rate hikes and all the rest of it should go out the window. So no, I don't think the economy is it's not booming or anything like the US might be, but it's still doing fine, I think.
We need to talk about UK politics as well. I suppose a relatively busy week just gone and an even busier week potentially coming up. We saw the Defence Secretary John Healey resign last week, and a couple of secretaries and so on followed him. Is that a coincidence that happened within a week of Andy Burnham contesting a by-election and potentially returning to Parliament? And I suppose the big question, of course, is what does this all mean for Keir Starmer and his future?
That's very cynical of you, Ollie. The timing was interestingly, yeah, appropriate, wasn't it? The fact that Burnham may well win the by-election in Makefield this week, and then potentially trigger a leadership election over the summer. And obviously, John Healey, by resigning on a point of principle, has clearly done himself no harm in terms of his reputation for whatever may come next. But I'm sure he would say it's over bigger issues like how we fund an increase in military spending. But it does look like Burnham's going to win this week, and then that will kickstart several weeks of speculation and probably potentially a new leader to be announced in September. So there's a whole summer of fun UK politics to look forward to.
Thanks again, Richard. How dare you call me cynical? But otherwise, I think that was a very useful response there. Final question for you now. I'm sure you saw this one coming. It's central bank season again. We had the ECB raising interest rates last week, and I don't think that came as a surprise to anyone particularly. We've now got a busy week incoming with Bank of Japan, the Fed, Bank of England, all updating their numbers as well. And actually, a few other of the ones outside of the G7 as well. Are we going to see any big surprises from those names this time around? And I guess maybe if I roll back into it, is the announcement of peace between US, or potential peace, let me say, between US and Iran, is that going to change anyone's perspective, do you think?
Yeah, it might do at the margin. I mean, the central bank meetings aren't for a couple of days, so we'll see if things are still the same. I mean, the Bank of Japan is likely to raise rates. They're coming from a different starting point, and in some ways, sort of similar situation to the ECB. Kind of rates are fairly low, so kind of no great surprise. They want to put them up a little bit at the moment. I can't see the Fed and the Bank of England doing anything, and the very fact that there's peace talks seem to be making progress means that there really is not much reason to go and put rates up at this moment. They're still very much in a wait and see mode, and I think if there is peace deal, any rate hikes can wait for some time. I think what's going to be interesting is this is Kevin Walsh's first Fed meeting as Fed chair. He's not a big fan of forward guidance or anything like that. So exactly what he's going to say in the press conference, I don't know. But it will be interesting to see the dynamic of him take over. I mean, we've kind of forgotten some of these issues because of the Iran war, but the whole Fed independence thing is a big deal for markets. So I think certainly bond investors will want to see that Kevin Walsh is his own man and not kind of just doing Trump's bidding. And if inflation does become a problem, he's prepared to put rates up. So a busy week ahead.
Richard, I'll let you take 5 there, and we'll turn to Ben now, who is here to talk about tech with us. Good morning, Ben. It's been a funny couple of weeks in tech. The Nasdaq sort of peaked in early June and has been struggling a little bit since then, partially off the back of Broadcom's Q1 statement. I realise it's a couple of weeks back now, but perhaps you could just set the scene with a bit of a recap of what's happened since.
Yeah, of course. Thanks, Ollie. There's been a few interesting what we call off-cycle prints. So, we're largely through the Q1 reporting, but companies like Broadcom, Palo Alto, Oracle have all reported. And look, after the real story has been a very strong performance from semiconductors, up about 95% year to date, whereas the software sector has struggled a lot more. And Broadcom's numbers were a reminder to investors that in such a strong semiconductor tape, you need to beat and raise. And so they reported very good numbers. Revenues were up 48%, and they guided to 84% growth, but that's still slightly disappointed people's expectations. Other little niggles that as an analyst we like to look at: gross margin was also guided flat, maybe even to down, and semiconductor stocks often work when gross margins are going up, not down. And then also Broadcom is starting to see a bit of competition from a company out of Taiwan called MediaTek. Their biggest customer, Broadcom's biggest customer in AI chips, is Google, and Google's starting to use a little bit of media tech in their production. So look, again, a reminder that you need to beat and raise, and that competition exists. Now, in terms of the other two results, Palo Alto, a good bit, had a good performance. AI is going to do many things, but it's also going to increase the number of threats that we potentially see from a cybersecurity perspective. And so we still continue to like cybersecurity. And then Oracle was a sort of a microcosm of what I started talking about at the beginning. They have essentially two businesses. They have their traditional business, the database and software business, which actually continues to see slowing revenue growth. So, not good for the software setup there. But they have a newer business called Oracle Compute Infrastructure, OCI, and that continues to go pretty well. They're building out data centers for various people, and they continue to do that, continue to see good returns from that business. But they're also raising 40 billion in debt and equity. So Oracle in itself is a sort of microcosm of things that are happening. But yeah, hopefully that helps, Ollie. In general, we tend to remain pretty positive on tech, but you have to be very tactical about where you position. Semis is working much better than software, for example. And of course, people after big runs like this, people are nervous about bubbles and deflation in the Nasdaq. We think at the moment there's still good supportive demand and supply. There hasn't been any big changes in demand, which of course is the big signal that would make us less positive.
It's useful context. And I think we also ought to bear in mind, of course, there was a bit of a recovery that took place last week, particularly around on Friday. And I suppose that was at least partially catalyzed by the SpaceX IPO. Now, full disclosure, it came as a bit of a surprise to me to be reminded, although it does make sense when you think about it, the SpaceX isn't actually a tech stock, so perhaps not exactly in your wheelhouse. And actually, I suppose when we think about it, something like Tesla isn't technically a tech name either. That being said, it did seem to have some impact on your sector. So do you attribute last week's recovery to SpaceX? And I suppose the fun bonus question, can Elon Musk actually be king of the tech bros if he runs a consumer discretionary in an aerospace company?
Yeah, let me just make some commentary because I'm not the covering analyst, as you say, for SpaceX. So let's just talk a little bit about the IPO. I mean, look, there are three businesses within SpaceX. 20% of revenues comes from the sort of SpaceX, the launch business, which I think of as the sort of the gateway, if you will, to space that Elon's trying to open up. The key fact you need to know is that in the days of NASA launching rockets, or in the early days of SpaceX, the cost per kilogram to send a kilogram into space was about $20,000. By mainly the reuse of quite a lot of their technology and rockets, they can bring that down to nearer $1,000. So a 20x, reduction in cost. And there's a possibility that with Starship, the version 3, they can bring that down even further. And that's quite interesting for the future. So that's the first business, the launch business. The second one that's the sort of cash cow, if you will, is the Starlink business. Now that's a broadband, so providing broadband using 10,000 low Earth orbit satellites, and their plan is to increase that to 30,000. And their plan is to have move their number of subscribers up from about 10 million subscribers up to about sort of 50 million. Sorry. So that's an interesting business for them. And then they've got a whole load of other little businesses. They have got XAI and a sort of a neo cloud business that creates a little bit of revenue, as I say, about 15%. And then you've got some other things that are a bit more aspirational. You've got the what's called the Terafab, where Elon wants to produce his own chips. So building sort of a bit like a TSMC, but even more vertically integrated than TSMC. He also wants to do data centers in space. And again, that's very contingent on the cost per kilogram coming down. And then even in the S1, he talks about asteroid mining. So there we are. We often talk about stocks going to the moon. This one quite literally could be going to the moon or beyond. So we think the IPO is good for sentiment. The important thing, though, to remember is that even though it's a market cap of 175, in fact, it'll be even more than that because the stock was up 24% on Friday, they are only raising less than 5%, so around sort of 75, 80 billion. So, if you're trying to think that all this money is going to flow into SpaceX, actually the amounts are relatively small. Valuation is also quite spicy, so it's going to be a very interesting couple of months now where we start to see broker research, we start to see what the sort of real secondary market looks like, and then of course there's going to be some lockups. Investors in SpaceX pre the IPO can start to sell down if they wish to. So it's going to be quite a ride, but I think SpaceX getting off to a reasonable start does help sentiment a little bit, but I'm personally more excited about the IPOs of Anthropic, OpenAI, reasonably excited, but Anthropic's the one I think is going to be really interesting for me.
Can't wait to revisit those two. Let's wait and see. Final question for either of you actually, but for Ben. You've given us internally some really useful insight in some of the meetings we've had last week about the importance of memory stocks to the AI boom, and we'll neatly segue from those AI IPOs to this question. Would you say this sector has been overlooked compared to some of the big name chip makers, and perhaps could you give us a quick synopsis today as to why this area might be worth a closer look?
Yeah, look, so for context, AI capex grew 70% last year. It's going to grow 80% this year by the releases that all the big hyperscalers have talked about, and it's probably going to grow about 35% next year. And lots of that will go on building the shells to make the data centers, the physical infrastructure. Some of it will go into the chips. And some of it will go into, memory, networking, cooling, and all of those kinds of things as well. And so memory has become a lot more important when you start thinking about how you use AI. So, very simple example, when you use OpenAI, ChatGPT, or your other chosen large language model, it will remember what you've been talking about over the last few sessions. In fact, it will remember pretty much every conversation you've had with it. And it will also be able to give context. So when you're asking a question, it'll be able to respond to the context of the situation. All of that requires more memory, various different types of memory, high bandwidth memory, DRAM, flash memory. I won't bore you with all the technicals, but what that means is strategically, memory is very important for the rollout of AI. And in fact, the amount of memory you need compared to, let's say you use 1 unit of memory for an AI for search, then for using inference, i.e. using ChatGPT, you need 10x the amount of memory. And then as we move to what's called agentic AI, we start to give agency or actionability to the AI, that's going to require another 10x, so 100x compared to a search. So huge demand for memory. That has meant that the memory price has done extremely well. It's up over 4x in the last year. And that means memory stocks have done quite well. But all of that has been driven by the earnings power of these companies. And to give you an idea, Micron, their EPS last year was around $6. And this year they expect their EPS to be around $100, in fact, slightly over $100. That price is all being driven by that very strong demand, as I say, strategic, importance of memory, but also the fact that now the memory market, well, particularly the DRAM market actually, is a 3-player market. And so that typically and historically, when the price went up very significantly, one of those players would add capacity and sort of bring the price down. What's actually happening is those 3 players are staying very rational, and they are not adding capacity. They're adding some, but not, not swamping the market. And then the final thing that's keeping the market sort of rational, and actually one of the reasons we think that memory price is going to continue to do well, and the memory stocks are going to continue to do well, is that they're starting to sign longer term agreements with their big customers, the hyperscalers. And this really gives you an opportunity to reduce the classical cyclicality that memory has seen. And that we think means that historically very cheap memory companies can begin to re-rate. I'm not talking about re-rating double or triple, but I do think that they could start to command something nearer a market multiple. So look, overall we remain reasonably happy with and content with the outlook for memory. However, big caution: we're not saying that the memory industry has become acyclical or the cyclicality has gone away. We are simply saying that we think that there can be a bit less cyclicality in the memory market. So hopefully that helps, Oli.
It does. Thanks, Ben. A lot of big numbers in all of that. Yes, and our lawyers have asked me to say that other large language models are available, of course. Look, I think that's probably all we really have time for today. So thank you both very much, as always, for those insights. We've covered a few topics today. I hope it's been useful to you, the listener. Before we draw to a close, if any of those listeners do have any questions that they would like to ask one of our analysts, Ben, Richard, or anyone else for that matter, you can, of course, put those questions forward to our team of experts by submitting them via the weekly comments page on our website. And we do read them. We do use them to form content for these podcasts. So do please keep coming in. To stay up to date with our thoughts on markets and current issues, do please visit the website, www.quiltercheviot.com. You can also see more of what we're doing at Quilter Cheviot, as well as watch past webinars on demand, and of course subscribe to the weekly comment newsletter if you are not already. We'll be back as usual next week, and in the meantime, for those of you on social media, you can of course stay up to date with all our content on Facebook, Instagram, and LinkedIn. So thank you once again to Richard and to Ben for your time today, and thank you all for listening. Bye.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.